All right.
What's up?
What's going on, man?
Nothing much, brother.
A little
bit closer. Am I screwing up
there
your...
we go. Yeah, my
you're like 73 cameras in front of us now.
I know.
Hey, everybody. Welcome to our Friday Live here. Scott DiGregorio with...
Gardo Ballantyne.
Primary Residential Mortgage, coming to you from Naples as usual.
That's right.
My wife asked why we don't do this in Fort Myers more.
Well, I'm more important than you are, so...
You know, sometimes you just speak the truth. So, anyway, man, let's go ahead and get started, man. We actually have a lot to talk about, man.
Yes, we have quite a bit.
It's been a busy week, and we had notes. We even got notes, people. We're bringing value. We got notes.
Dude, it's been exciting, man.
Yeah,
it's been exciting. I think in the past couple of weeks we've been able to help a bunch of people.
Yes.
And look, what I love about this is we've been able to help a lot of people that we haven't been able to help before. And that's where it's really exciting.
And just all product development.
It's all product development. It's all these new things that are coming with primary, and really we're trying to reach to more people, right?
Yes.
We're trying to be able to give loans to more people. And for those of you that I know that get a little nervous about maybe the fact that now these agency guidelines are getting looser and all of that, these are very qualified people in real life. It's just that they don't fit in the little box that we normally have to fit them in.
I'm with you 100%, but to take my wisdom with this, it does have a slight 2001 feel.
I was in high school. So
no, yeah, I know. You were.
Doesn't feel like that at all.
You're still a little mommy, but I'm starting to see products coming out that are a little reminiscent of kind of the old subprime days. So it will be interesting to see what this leads to. But as it sits today, you're right, man. They're non-conventional products, unconventional products for super qualified clients.
Yeah, and that's the thing. It's for super qualified clients. They just don't fit in the box that we normally want them to fit in. So, for example, just let's start with the bank statement loans that we have.
Go.
So we have two bank statement loans. We have one where we look at the last 12 months of bank statements, the personal bank statements.
Right.
Or we have another one where we're going to look at 24 months of the business bank statements.
Correct.
And just so you have an idea, I qualified a lady yesterday where if I just look at her tax returns, she will make about $4,000 a month.
Okay.
But when I look at her bank statements, which is, we can argue that that's her real income.
We can.
Right? I have an income of $13,600. $13,600 a month.
And that's qualifying income.
That's qualifying income.
And
that's qualifying income.
So let's talk about that, right? We're not taking 100% of their deposits.
No.
We take a formula off of that. We deduct a certain amount, and then we apply a percentage. So her average deposits must be substantially higher than $13,000.
It's more than 50% higher.
Yeah. So this program is really not good for small self-employed people that are depositing $2,000, $3,000 a month, $5,000 a month.
Correct.
But I know I did a loan where, same thing, I literally tripled the person's qualifying income and was able to get the deal done. So,
and that's exciting. And look, if you're self-employed and you haven't been able to buy a house because of that, or if you're a realtor and you have a client that maybe they want a house for $300,000 or $400,000 because they actually make good income, but they can only qualify for $150,000.
Yep.
This is a great option for them.
It really is.
There's no mortgage insurance on these loans.
Mm-hmm.
And it's just a good option.
And it goes all the way up to $3 million. So this is good for smaller loans and jumbo loans as well. And I got to be honest, I think there's almost more value for it in the jumbo market.
Absolutely.
Very often those are the people that have all these kind of things in the fire.
So what's the negative with these loans?
Interest rates a little higher.
Interest rates a little bit higher. You need to put 10% down at least.
I don't call that a negative, but yes, that's a characteristic of the loan.
Yeah, we need to put 10% down at least, and that's it. Other than that, they're good.
We could do non-warrantable condos. We could do regular condos.
First home, second homes.
Yep, different occupancies. So very, very broad. The other thing that is exciting is the introduction of an interest-only option.
Yes.
Okay, now
you can combine these two.
Yes, you can. You could go bank statement interest only, but now we're talking that's big league stuff. But look, you can. We have a product now where it is a interest only for the first 10 years, and then a 30-year fixed.
Yes. So you can pick actually. You can take interest only for the first 10 years, and then it amortizes for 30 years fixed, or interest only for the first 10 years, and then it amortizes for 20 years.
Yes. Yeah, you could do that, and look, I know it's off of products a little bit, but I think it's worthwhile to talk about the market too.
Sure.
You know, we have seen, if you look at the markets, if you're thinking of buying or selling, this is applicable. If you look at the market stats, which if you don't have them, reach out to us. We can send them to you for either Lee or Cuyahoga County. But the market is continuing to slow down. And one of the things I saw on the most recent stats that were published, which was March, is, and this is the first time I've seen this, the median sales price has declined.
Yes.
It is not declined a lot, but it's declined. So length of time on the market is increasing.
There's more inventory.
More inventory is increasing. The number of the difference between asking price and selling price is increasing.
Again, not by a lot. Don't go crazy.
Yeah, don't go nuts.
Don't go crazy. Putting offers 20% off.
No, that won't work out. Yeah, look, it dropped from 95.7 to 95.1.
Right.
So I mean, but again, it is showing a slowdown in the market a little bit, and so look. Is it a good time to sell? Well, if the market's slowing down, selling today versus next month, if the slowdown continues, is a good thing.
Makes sense.
From a buying standpoint, here's the good news. I think property values are stabilizing. I don't think they're I understand the median dropped a little bit, but I think sales prices are stabilizing. So the good news is this. You don't have to feel rushed to buy a house to prevent the market from getting out of hand. And interest rates have actually decreased.
Yes, interest rates are being great so far.
So if you're buying a house, there's nothing in the market that should make you feel rushed. Take your time. And look, I tell people this all the time, and I'm sorry, it's true. As weird as it sounds, you'll walk into a house and you'll literally just know. Like, it'll feel right almost instantaneously. So whether that happens now or 3 months from now, doesn't matter. I don't see the interest rate or the real estate market influencing or hurting you if it takes you a little longer. Yeah. And that's a good thing. That's a good thing.
Now, at the same time, what about this strategy of waiting 6 months for everything to collapse?
Yeah, that's a great thing.
Talk too.
That's nonsense. So look, and it's I understand it. People hear the word recession and they think of the most recent one, which is 2008.
Right.
Keep in mind, 2008 was not. I mean, yes, was technically a recession, but 2008 was the second biggest economic collapse in American history.
Right.
Okay? You know, we've been in an upcycle for a decade now. You have to have recessions and downturns, and they're healthy. And you know, we had a correction in the stock market in December.
Yeah, December.
Okay.
And
boom! Since then, so just
everybody
relax.
Yeah.
You're not going to be able to buy houses for $80,000. So just that's not a thing. Okay. I think I want to talk about literally this morning driving here.
Wait, before we go off of the bank statement,
No.
One thing I forgot to mention is you need to have a credit score of 600.
Yes,
600.
Yeah.
Okay.
And the lower the credit score, obviously, the bigger the down payment.
Correct.
Okay,
and the interest is going to be worse.
Yeah, all that stuff. So, but we can't go down as low as that.
As low as
and
600,
I want to talk about. I don't know if anybody's interested in buying stuff from Lennar. What's up, Eric at Arborwood? Love you, brother. But I actually got 2 contracts from them for the non-warrantable condos.
Okay, so
what the heck is that?
What does that mean? Why does Lennar come into the equation here? What are you talking about?
Okay.
I know, as far as people are concerned, they go to Lennar and they're pushing their lender.
Right.
So why the hell are you talking about Lennar?
And the other thing people are thinking is a condo is a condo is a condo.
Correct.
And that crap shit's not true.
That's not
Okay,
like
so
that.
all right, so look, so here's the deal. In order for a condo to be warrantable, it needs to meet Fannie Mae's guidelines. Okay. And there's 27 questions. There's a lot there, but specifically with new construction, one of the requirements for a condo to be warrantable and meet Fannie Mae's guidelines is the condo cannot be in the control of the developer.
So what that means is those condos are non-warrantable.
Right.
Just for all purposes. New construction condos, not good for Fannie or Freddie.
Unless it's at the very tail end of construction they're finishing. So
Fine.
Condos are non-warrantable. Lennar has an in-house lender.
Right.
They give away all kinds of money. Here's the cool thing for us. Their in-house lender does not do non-warrantable condos.
Okay, so what do you guys do? You go there, you try to get the loan with them, you get declined, and then you call us.
Right. And I was able to help 2 people. One of them was actually working with another bank who couldn't qualify them, and I was able to. So non-warrantable condos are a big thing, and we should probably remind everybody about the down payment assistance expiring.
Yes. So remember, we were talking about last week that we have this down payment assistance through FHA that works in conjunction with FHA. That means that you can get into an FHA loan with, instead of having to put the 3.5% down, we can help you with that down payment. However, the only thing with that is we only have until the end of July.
End of July.
The end of July for you to not only get qualified and all that, but also to find the property and get under contract.
But why the hell is that? What happens at the end of July?
For all purposes, that program is not going to be available anymore.
All right, so he doesn't want to give you the details, apparently, so I'm going to. Look, HUD, right, Department of Housing and Urban Development, that controls FHA, HUD issued a what they call a mortgagee letter, and they said, look, we're suspending these down payment assistance options. And then almost immediately thereafter, they issued another notification, said, we're going to hold off on that change for 90 days. The 90 days expires the end of July.
And that happened last week.
Literally last week. So now, can crap change between now and July? Sure. But as it stands, right. But as it stands right now, as of the end of July, if you don't have a home picked out and your loan process started, you are not going to be able to get that down payment assistance on an FHA loan, and it's going to hurt people.
And the thing is, it's not a matter of just getting qualified or even closing. You just we have to start the process. We need to get under contract. We need to be able to send that FHA case number,
right,
and then you'll be good.
Absolutely.
But again, it's 90 days. It's an amazing program. Again, FHA, so you have all the good stuff that comes with the FHA loans, and you don't have to bring any down payment. And as you know, or as I'm sure you know, when it comes to FHA loans, we can ask for up to 6% seller concession. So virtually, you can go into a property and the seller pays for your closing costs. We take care of your down payment, and with very, very, very little to no money down.
Less than a rental.
Much less than a rental.
Much less than a rental. So, so that's cool. And then I think we tie this point in and this point in together, right? Because our question, man. I mean, is there anything else in your mind before we go question?
No, let's the question, yeah, we can take care of the question. The question is, how can I invest with very little money?
And by little money, he was referencing the question referenced down payment.
Down payment specifically. So,
because that's a challenge.
So typically, you need to put at least 15%, but we like to say you need to have at least anywhere from 15 to 20% down if you're buying an investment property. Now, an investment property is a property that you're going to rent out. Right. This is not going to be, we can, if you live in a house, you can't call the house next door another primary property.
Right. Or a vacation.
Or a vacation. Right. We can't do that. So typically, you need to put 15 to 20% down. Now, there's a couple of hacks. There's a couple of things around it, right?
Of course.
So if you currently don't own a property, right? Mm-hmm. If you don't have a home right now, or even if you own a home and you're willing to move into, let's say, a duplex or a triplex or a fourplex, and you don't have an FHA loan, you could get into that multifamily home, whether duplex, triplex, or fourplex, with the minimum down payment, which is 3.5%.
Yep, absolutely.
So only 3.5%. And then you still have the ability to rent out the other units.
Absolutely. And maybe that's something you want to live in for a period of time and eventually move out of. Just to be clear, if you buy it that way and rent out all the units immediately, that's called mortgage fraud.
That's a problem.
And I hear the food in jail sucks.
Yes.
I don't know. But I know it's punishable by up to 30 years in prison and $1 million fine.
Yes.
Don't freaking do that. That's not worth it. Jail, I gotta think, sucks. Yeah. So, but if you are going to live there...
Yeah, if you're looking for your first home, for example, and it doesn't have to be your first home, but if this is your starter home, this is not a place where you're going to live forever, that's a good idea.
I used it, man. I bought myself a duplex in Bonita for $144 back in the day, and... It's it's a great way to have a very low house payment.
Sure.
I remember specifically my mortgage payment was $11 and change a month. I rented the other side for $700.
Yeah, there you
go.
So
yeah,
$400 for your house.
Yeah, for a mortgage. Yeah, for my house. So that's one way. And the other option is to buy it as a primary first. And look, Tyler, I don't know if you watch it, brother, but I think man, I had this young guy come to me, and he wanted to build up a real estate investment, empire. And he came to me and he put together a plan, and to his credit, brother did it. So here's what he did. He bought a house, moved into it.
Okay.
Lived there for a year. Okay. And during the year, fixed up the property.
Okay.
Flipped it, sold it. Okay. Rolled the money into another one. Okay. He did that 2 or 3 times. By the third time, he had enough money that he could then buy 2 properties. And it took him some time, but I mean, he really has a real estate investment portfolio now. He's done a hell of a job. So you could go the multifamily route, but you could also go the single family route where
Right, absolutely.
just buy it. Now look, I don't know if everybody knows who Gary Vaynerchuk is. What's up, Gary V? I love you. But
I'm sure he's watching.
Gary, he watches all my stuff. Gary V is big on promoting patience.
Okay.
So look, you want to build up an empire tomorrow? Not a problem. You need a lot of freaking money.
Yes.
Okay. You want to deploy some patience. Let's see. What about the 2 years required for to qualify for a mortgage? We're being asked. Thank you for the questions. I'm assuming you're. I don't know what you're referring to with the 2 year thing. So there's a couple pieces of it. You don't necessarily need 2 years employment like you used to. There's really a lot of flexibility in that a lot of people don't understand.
You don't have to be in the same job for 2 years
right.
or anything like that.
Nothing like that.
Now, if you're self-employed, you need to have 2 years of self-employment, or we would like you to have,
generally speaking,
24
yes.
months. But again, there's a little bit of flexibility when it comes to
There
that.
is. And then the other thing that he may be referencing in the question is, it used to be, and this is before your time, but it used to be that you need a 2 year history of being a landlord before you're able to buy an investment property and count the potential rental income. That guideline's gone.
Yeah, that's not like that.
That is gone, man. So if you're buying a rental property,
it could even be your very first home. Going back to
yes, it can.
I mean, going back to buying your primary residence in a duplex or a fourplex, and we still count part of the income that we think you're going to get.
Absolutely. Look, there's nothing.
Houses don't need to be rented.
Look, dude, there's nothing stopping you from if you rent your current house to buying an investment
Right,
property.
absolutely.
It's not the path most people take, but
Right.
you certainly can. You certainly can. So buying it as a primary first, and then eventually flipping it into a rental is one sensible way of doing it. Buying a multifamily property, living there for a period of time, and then again renting it all out is another option there. But what about the people that, hey Scott, I bought my house maybe in 2010, 11, 12, 13, 14. I'm now sitting on $100,000 worth of equity. I want to get going. Look, the HELOC's the angle right
Dude,
there.
I did that for my investment.
Yes, you
property.
did.
I did that.
Yes,
I
you
went
did.
ahead.
So tell everybody.
I had my primary residence for a while. I had enough equity built that I could take a home equity line of credit. The home equity line of credit it's close to free,
Right.
I had to pay very little money. I had to qualify, of course, but if you're buying another house, you need to qualify anyways, and it's virtually the same documentation, so you might as well just do it once. I got my home equity line of credit. I used that home equity line of credit as a down payment for my investment property, and my investment property paid for the line of credit
Yep.
and paid for itself.
Yep, and down the line of credit's paid off.
Now the line of credit is
And
paid
you can
off,
do it again.
I can
right?
do it as many times as I want
Yep.
to. I pay, I want to say $50 a year for that line of credit if I don't use it. So again, it's virtually free. And the investment property is there. I didn't have to spend any money out of pocket,
Smart, man.
any money from my money to do that.
So leveraging the equity in your current house,
Absolutely.
buying a multifamily and renting out the other units, or buying it as a primary and then eventually converting it to an investment property are all solid strategies. Well,
They're all great.
what about programs that have come out where the challenge is not down payments, the challenge is debt to income ratio, qualifying for the
Right.
mortgage. What do we have for that?
Well, so there's a couple things. On a regular mortgage, we're going to at least use the projected rental income.
Yes.
And again, I just want to clarify that property doesn't have to be rented by the time you're buying it, right?
And if you are, how much it's rented for is ignored.
It's ignored. We're going to see what the projected income is. So the appraisal is going to look at the property and is going to say, okay, not only this property is worth what it's worth, but we also can expect you to receive $1,500, $1,000 a month on this property. And then what we're going to do is we're going to use a percentage of that and add it and pretty much counter it
Yeah.
against what you're going to pay for that property. So
And generally it's 75%.
generally it's
generally.
75%, and generally, at least in this area, it's a wash.
It
It's
should
not-
be.
Yeah.
It absolutely should be.
So that's that. If you want to read that while
I think it's the same. Yeah, they told me I have 2 years in one in order to buy my house. Also, they told me if I have left. Hey, do me a favor on that question. Go ahead and DM me. It's getting into some of your personal financial stuff. If you go ahead and DM me, I will definitely be able to answer those questions. Some of the answers they seem to be giving you is not correct. And look, it touches on an important thing, right? Agency guidelines and overlays, and this is
Yes.
big. You know, I talked earlier about the bank couldn't do the loan, but I'm able
Sure.
to. So Fannie Mae, Freddie Mac, FHA, VA, they could say, here's our minimum guidelines. any bank could say, I want a more stringent guideline over and above that. And
like what, for example? We see a lot of guidelines when it comes to credit scores.
Credit score.
Right? For
Credit
example,
score.
FHA says in order for you to put a 3.5% down, you need to have a 580.
Right.
A lot of banks will say, well, that's nice.
That's great.
But we need you to have a 660 or we need you to have a 640
or 600, whatever, just something. So, back to the question. It seems to me like the answers they're giving you are more overlay related than agency related. And if you DM me, I'll be able to kind of set the record straight there.
So I was saying we can use the projected investment from the house. Now let's say that's not enough. Let's say that still you're self-employed or whatever
it is,
and you don't have enough money. Well, we just launched a program where as long as the property cash flow positively, so as long as whatever you're gonna pay, now that includes principal, interest, taxes, insurance, and HOAs, it's gonna be less than the projected rental income. You're good.
But wait, I'm sorry. So let me feign excitement or ignorance. So you're saying no income taxes, no personal income at all.
No.
The property in and of itself stands on its own two feet.
It has to sustain itself. And as long as that happens, now there's other requirements. You have to have a 660 credit score. You need to put 20% down.
I was going to say, you need a decent down payment.
You need to put 20% down. You need to have a 660 credit score.
But you're not going to have a 5% interest rate on this program.
No. You're not going to have a 5% interest. But, again, it's all about cash flow at this point.
100%.
As long as you're not paying more than what you can rent this property for, we don't ask for any more income documents.
Absolutely. That is, man.
And it makes sense.
Look, it's... so many of these freaking products finally make sense.
Yeah, come on. And that applies for non-marketable condos as well.
Yes, it does. So look, if you want to get started as an investor, just take these things to note. DM us. I know we have one person watching that has questions. Go ahead and DM us, and we'll help you. I can tell you this: investing in real estate is critically important. Said every rich guy ever.
Yeah.
I mean, it's just.
Yeah.
It's just big, and I understand 2008, and I understand you could get burned. You have to do it right, but
you gotta be smart and ask questions.
Rich people have investment properties. Yeah. So if you want to be wealthy one day, you want to have money one day, that's a strategy that 100% of people follow. Yeah. So
one last thing we can do on that investment cash flow program that we have, you can do interest only as well.
Yes, you can.
So if you want your cash flow to be real good, you can just do interest only, and then just plan accordingly.
And look, I mean, this is along these lines. I by the way, if you're just starting to think about investing, let me throw this thought at you. I think you have to start off by understanding which of the 3 investment buckets you're going to fall into. Okay.
So what are those?
All right. So the 3 investment buckets: 1, fix and flip. You're going to buy a house, fix it up, flip it quick, and put short-term money in your pocket, okay? That's getting harder and harder to do as the market matures. But anyway, that's an option. Second option, long-term. Okay? You're going to buy a property. If the darn thing breaks even, you're happy because you're going to work off of the equity being built up through the property going up in value and the amortization, okay? The tenants are going to pay off your mortgage. Property's going to go up in value, and down the road, you're going to have a big asset. That's one of my loves, right?
It's a great way to earn more income in your retirement.
Exactly.
You're thinking 30 years ahead, 20 years ahead.
Right, and then the third one,
case, maybe 5 years ahead.
and then the third one is just cash flow.
Yes.
Okay, and cash flow, very often you're looking at multifamilies, duplexes, triplexes, fourplexes,
or options like this, interest-only options, investment properties, things like that.
So you gotta understand the type of investor you want to be. There's pros and cons to all of them. How we should do that on our next Facebook Live. Yeah, because we can really break that down.
And based on that, then you can start looking for that property, because that's what if that's your end goal, then you can look for a property that will satisfy that.
Yeah, and by the way, there's one other kind of quasi category where maybe you want to buy yourself a vacation home and occasionally rent it.
Absolutely.
Danielle and I are thinking about buying something in North Florida, Georgia, something like that. Exactly.
Yeah.
And look, we live in a VRBO world right now, man, where I did a loan once for a gentleman that had a property in the Cape, nothing special. Sure. Through VRBO, he was bringing in like 50, 60 grand a year.
My mother-in-law, Nina, what's up? If
what's up?
She did the same thing. She bought a nice...
She's not watching.
She watches later. She watches me. Anyways, she bought a little cabin in Blue Ridge, Georgia, and that thing is renting like crazy. It's short-term rental, but it's renting like crazy. Pays for itself and a little bit more, and she goes there once a quarter.
Yeah, and look, and nowadays you're allowed to buy a second home, a vacation home, and rent it out up to half the year. And with the second home, conventionally you're looking 10% down.
10% down, lower interest rates. It's a great deal.
It's another option. So look, lots and lots of options out there. Reach out to us if you have any questions. Otherwise, I guess we'll see you next week.
Look, and the example on your feed right now, reach out to us if you have any questions or if you heard something somewhere else that maybe you're not sure about, or if you just want a second opinion, just let us know. Because a lot of times it's not the fact that, it's not that you don't qualify, it's just you don't qualify for that particular bank or for that particular product that the bank has.
Yeah, and look, be careful what you read online, okay? And you know, we actually read a blog on the topic, and one of the topics was buy a home as a primary residence with 1% down and rent it out.
Yeah.
That's fraud.
That's fraud.
Don't
It's
freaking
a
do
big
that,
deal.
okay? The mortgage guidelines change literally weekly, okay?
Yeah.
You're reading a blog that's a month, 3 months old. It's dated information, so please reach out to us because stuff changes all the time.
Yeah.
All right, that's what I got.
That's it. Last thing is my brother's birthday is today, so happy birthday,
What's
Nico.
up, bro? And follow my video library, FloridaMortgageExpert.com. Follow his
Just go
YouTube
on the link
page.
below.
Yep, follow the YouTube page for him. And we'll see you next time.
We'll see you
Take
next
care.
time.